Hey everyone, welcome back to Financial Market Insights for Traders, the podcast that cuts through the noise and gets to the core of what really moves the markets. I'm your host, Sophia, and today we're diving deep, really deep, into the world of hedge funds. If you're an advanced retail trader or an ambitious intermediate looking to level up, this episode is designed for you. Today's focus is inside the mind of a hedge fund, strategies of the big players. Let's get started. Now, hedge funds are often seen as the apex predators in the financial jungle, fast, aggressive, secretive. They're armed with elite teams, vast data sets, bleeding edge tech, and seemingly limitless resources. But what if I told you that many of the tactics used by these big players are accessible, even replicable, by advanced retail investors? That's what we're exploring today. We're not just talking theory, we're talking strategies, real frameworks used by firms like Citadel, Bridgewater, Renaissance Technologies. I'll break down their core approaches and then translate them into practical ideas for you. Segment 1, the hedge fund mental framework. Let's start with mindset, because before they touch a trade, hedge fund managers think differently. And this is where the real edge begins. Here are 4 foundational pillars of how these managers operate. Number 1, probabilistic thinking. Every trade is viewed through the lens of probability, not certainty. They use models to assess thousands of scenarios, weighing the upside and downside. Number 2, risk concentration. Hedge funds don't spread thin across dozens of bets. They concentrate capital where the expected value is highest. Number 3, diversified strategy stack. No single magic system. Hedge funds run multiple strategies concurrently, aiming to reduce correlations and smooth out returns. And number 4, constant optimization. No strategy is set and forget. Everything is optimized continuously to account for slippage, market structure changes, and strategy decay. If you're a serious retail trader, think beyond setups and signals. Think like a portfolio manager. Stack strategies. Monitor your risk-adjusted returns. And above all, optimize. Segment 2, long/short equity, the core strategy. Let's jump into the first big one, long/short equity. This is the bread and butter for many hedge funds. It's simple in theory. Buy undervalued stocks, short the overvalued ones. You're trying to generate alpha, returns beyond the market, without being overly exposed to overall market movements. Citadel, Millennium, and countless other hedge funds deploy teams who pore over earnings, balance sheets, and macro forecasts. They match this deep fundamental work with quantitative screens to identify mispricings. Retail application? It's more doable than you think. Find relative value within a sector. Long one stock. Short a similar one you think is overpriced. Use beta-adjusted sizing to neutralize your market exposure. Monitor pair trades using tools like TradingView, FinViz, or Thinkorswim. Example, long Pepsi, short Coca-Cola, or long AMD, short Intel if you believe one's momentum is based on stronger fundamentals. This strategy can work in any market condition because you're trading the spread, not the direction. Segment 3, global macro, betting on big themes. Next up, global macro investing. This strategy is all about the big picture, central bank policies, geopolitics, interest rates, commodities, currencies. George Soros made his billions here, notably shorting the British pound in 1992. Macro-focused hedge funds combine economics, politics, and global flows. They might go long the US dollar if European instability looms, or short the yen and go long global equities in a reflationary setup. They might even go long oil if OPEC hints at production cuts. As a retail trader, how do you apply this? Track global events. Use Bloomberg, Reuters, and economic calendars. Express your views using macro ETFs, TLT for bonds, UP for the dollar, GLD for gold. Learn how rate hikes or policy shifts ripple across asset classes. And if you want beginner-friendly discussions on macro and algorithmic trading, definitely check out the Crystal Ball Markets podcast. It's built to level up your market IQ. Segment 4, quantitative and algorithmic trading. Third strategy, quantitative and algorithmic trading. Hedge funds like Renaissance Technologies and Two Sigma aren't just funds, they're tech companies. They deploy machine learning, statistical models, and high frequency techniques to identify patterns most of us can't even see. Common strategies include statistical arbitrage, mean reversion between related stocks, momentum systems, buying breakouts and shorting laggards, machine learning models, classifiers that predict price movement using massive data sets. Retail traders can get started with tools like QuantConnect or MetaTrader. If you're not coding yet, start learning Python. Libraries like Pandas, NumberPy, and Backtrader make it accessible. Build something simple. Test it. Refine it. And again, check out the Crystal Ball Markets podcast for step-by-step help on algorithmic trading for beginners. Segment 5, Event-Driven and Merger Arbitrage. Let's shift gears to event-driven strategies. These revolve around corporate catalysts, mergers, earnings announcements, bankruptcies. One famous example, Paulson Company, which made billions during the subprime mortgage crisis by betting against toxic securities. The core play? In a merger, buy the company being acquired and short the acquirer. You profit as the spread narrows, assuming the deal closes. Retail traders can watch deal news via Seeking Alpha or Deal Logic, then analyze the spread and deal terms. Use options to limit downside while targeting volatility around these events. It's complex but powerful if you know what you're doing. Segment 6, Advanced Option Strategies. Next, Advanced Options Trading. Forget the lottery ticket plays. Hedge funds use options for precision, for structure, for risk control. Popular institutional strategies include iron condors and calendar spreads for income, volatility arbitrage, profiting from the gap between implied and actual volatility, gamma scalping, managing delta-neutral positions around major events. Study the Greeks. Learn volatility metrics. Model your trades on OptionStrat. And if you're serious about execution, check out the crystalballmarkets.com platform. It's designed for advanced traders who want institutional-grade capabilities. Segment 7, AI in Stock Trading. Now let's talk about the bleeding edge, AI in stock trading. Some hedge funds scrape everything, news, transcripts, social media, satellite imagery, to generate edge using machine learning and natural language processing. We're talking sentiment analysis of earnings calls, retail sentiment tracked via Twitter, satellite data, think Walmart parking lot foot traffic to predict revenue. Retail traders can explore platforms like Trade Ideas or TrendSpider that offer AI-enhanced analysis, or go deeper with Kavout if you're comfortable working with data. Use these tools to layer sentiment and context into your signals. It's not magic, but it is powerful. Segment 8, Risk Management, the hedge fund secret sauce. Here's the truth. Every pro-level strategy lives or dies by risk management. Hedge funds don't YOLO. They calculate value at risk VAR, implement dynamic hedging, use stop-loss algorithms, and track exposure across asset classes. As a retail trader, steal this playbook. Use the Kelly criterion for position sizing. Cap your drawdowns. If you lose 10%, stop, reassess. Build a correlation matrix for your trades. If they all move together, you're overexposed. Hedge with VIX calls, SPY puts, or inverse ETFs. The key isn't just making money, it's keeping it. Final segment, think bigger, trade smarter. So, what does it take to think like a hedge fund? You need a strategy stack. You need discipline. And you need the right tools. Recap your playbook. Long/short pairs. Macro themes with ETFs. Algorithmic models. Event-driven trades. Advanced option strategies. AI-driven signals. Tight risk control. And don't forget, access matters. If you want institutional level tools without the bureaucracy, start with the crystalballmarkets.com trading platform. It's built for traders like you. That wraps up today's episode of Financial Market Insights for Traders. If you learned something new or feel more equipped to level up, subscribe, share the podcast, and check the episode notes for all the links mentioned. Until next time, I'm Sophia. Trade smart, think big, and stay curious.